but I will give you one anyways. So Joseph Lubin is co-founder of Ethereum, founder and CEO of Consensus, obviously one of the world's leading blockchain and Ethereum technology companies. Joe co-founded the Ethereum project, founded Consensus to focus on building Ethereum-based infrastructure, developer tools, and applications. And prior to working on Ethereum, Joe, it's I think it's known that you spent a career kind of at the intersection of cryptography, engineering, finance, in your role as VP of Technology at Goldman Sachs and in private wealth management. So welcome, Joe.
Thanks, Jacob.
Awesome. So we'll get right into things. Look, the call or the talk is really structured around the future of DeFi, but I want to start by kind of a sense of how did we actually get here? And obviously DeFi has grown by leaps and bounds. This year we're starting to see now NFTs take off. I think DAOs are starting to become really interesting, and the technology around governance is being formed. And we're starting to see the early stages of Web3 applications really come to how many expected, which is great. But shifting back to DeFi, I don't think many know this, but Vitalik actually called Ethereum the Lego of crypto finance back in 2014. The Ethereum white paper itself even calls out DeFi as the first category of applications for Ethereum. And it states the first category is financial applications, providing users with more powerful ways of managing and entering into contracts using their money. This includes subcurrencies, financial derivatives, hedging contracts, and so on and so on. So, it seems clear that DeFi was rooted, this concept of DeFi was rooted in Ethereum from the genesis. And yet you still see, many that feel like it came out of nowhere. So the question is like, how aware or mindful were you or others, as part of the founding team of this concept of decentralized finance? And did you imagine it looking like it does today, or was it more conceptual, just a blurry image in everyone's head? You knew it was possible, but you didn't really think it would look like, and so it was just build the protocol and worry about applications later? Or, was this core to the discussion? Just interested to take us back to 2014, basically.
So short answer, yes. I think a bunch of us were aware that finance was going to be an important application, and we're going to be able to pioneer a new approach. I think Vitalik wrote the white paper essentially because it was really hard to create a cryptocurrency. And so he wanted to reduce the amount of work needed to fork a whole code base and create a new cryptocurrency. All you get is another cryptocurrency, and reduce the enormous amount of work required in developing a community and standing up a network with lots of different validators, miners on your network. And so in April of 2014, we showed up at a conference in Toronto, and we had some smart contracts on the back of our Ethereum shirts. One of them was a Dropbox. One was a contract for difference, I believe, differences. I think there's another financial contract. But absolutely, we were thinking about simpler financial primitives, things like dead man switches, things like parameterized insurance for weather, for flight insurance, things like that. There's certainly no way that we could predict the details of what might happen when democratization hits finance. So similarly, I'm not sure you could predict the details of what might happen when democratization in the form of the World Wide Web hit information access globally, hit the ability for anybody to publish information or to erect an e-commerce platform or store or use e-commerce or social networking, etc. And so what we're seeing is just astonishing and wonderful because entrepreneurs and technologists are rebuilding finance basically. and I look forward to the day when it's not called DeFi, just Fi. We did some early projects. We did like NFTs in music, in real estate. At Consensus, we thought about things like 4 or 5 years ago, we thought about things like software bots that would monitor the network, because we knew that there'd be equities and bonds and derivatives and all sorts of other instruments, but bots that would monitor things in real time and automatically tranche up financial flows with different risk profiles, securitize those flows and sell them to other bots or sell them to humans, slower moving humans. One of our earliest projects was Gnosis, a prediction markets project. We were certain that prediction markets would fairly quickly become a ubiquitous financial primitive. And I think that's been slow for regulatory reasons, but I still expect that's going to happen. Interestingly, Gnosis built the first AMM that I'm aware of, the first automated market maker, and for trading tokens associated with their own prediction markets. We built something called EtherX early on, very early on. Vincent Gariepi put that together. It was an order book on blockchain, and it was too early for DeFi.
你们吃饭是吧？
bottom line
OK，
is,
好，我在听一个 conference， 你等一下，我马上过来。
Sorry.
Sorry, I think that was a mistake. Please go ahead.
So yeah, so the bottom line is the big vision was that we would re-architect society on a more sturdy trust foundation, foundation of automated and objective trust, rather than the subjective trust foundation that we've been living under for thousands of years. This new trust foundation, enabled by decentralized protocols, would enable essentially the building of the next layer, which is a global financial infrastructure. Upon that global financial infrastructure, we would essentially see the world re-architect different systems in different industries, different niches, etc. So we absolutely did anticipate that a fluid, real-time, friction-free global financial infrastructure was going to be one of the early goals and results of what we were doing.
Great. It's funny that you mentioned parametric weather insurance. It's like a super specific example, but I have a friend who's actually building that right now. So, you know, these early use cases that you guys imagined are starting to take shape.
Yeah. So I forget some Swiss guys who are friends. I'm spacing on their name, but they built that a few years ago and offered it at DevCon. So it's
cool.
It's been executed a few times already.
Yeah, it's funny how many of these applications were like too early, but too early in internet days would be like decades in advance, and now too early, and you know, Web3 is like a year or two too early, and then all of a sudden it gets reimagined and it launches once, you know, some new primitive gets launched. Consensus, you know, on that note, and you know, in the shortening of timeframes, Consensus launched CodeFi in September of 2019 with the vision, and I'm quoting, leading the convergence of existing and decentralized financial technologies to create more accessible and equitable financial services for everyone, everywhere. You know, so building on this theme of decentralized finance and the fact that this was a core idea, you know, generally, how is that going? Like, where does CodeFi sit in terms of like the organization of Consensus? Is it, you know, your fastest growing? Is it, do you see the most demand there internally, externally? Just wondering, like, at an organization like yours that has, you know, a lot of connection into, you know, plugged into the space, you have a lot of different pieces of infrastructure and software. And so I'm wondering, like, DeFi as a category internally, you know, where is that? And are you starting to see some early signs of this convergence being realized? You know, we'll get to this question of what the future might look like in a moment in terms of regulations in particular. But yeah, what is CodeFi, and like where are you seeing things grow internally, and is that vision starting to be realized at least?
So we call it Codify. It's code, it's finance, we're codifying things. Codify stands for Commerce and Decentralized Finance. We think it's a cute name. And Codify builds quite a few things. We also call it our vertical applications group. So it is quite a big group. It's not our biggest group, but it's a big one. Codify builds things like Orchestrate, which essentially enables the orchestration of different transactions with respect to nonces, and so basically helps make sure transactions are appropriately sequenced, don't hit the floor, etc. Does some business process workflow work, full life cycle asset issuance management, tokenization, etc. OTC markets through our AirSwap group. We've got different payments tooling and are doing a bunch of work on CBDCs with several central banks around the world. We are able to launch networks, so launch protocols, tokenized protocols. We've got a bunch of staking going on, built Ethereum 2.0 staking infrastructure, compliance work. We're building MetaMask institutional and data analytics, risk analytics, etc. It's probably best to understand the shape of consensus in order to understand Codify. Consensus is basically a blockchain stack, and we have three major practice areas or platforms: consumer, developer, and organization or enterprise. And so on the consumer side, our Codify group can build something like MetaMask swaps and deliver it to 3.5 million monthly active MetaMask users. And that's been a very exciting project. And we have a very durable relationship to consumers and to developers and even to enterprises. And so we can, in MetaSwaps, for instance, we're able to sit on top of an aggregation pyramid. So where there are DEXs, there are private market makers, there are aggregators, and we're able to aggregate all of that and provide a unified interface to nearly the whole universe of tokens and find the best price in real time for people. And we will continue to do that sort of aggregation work for consumers and deliver. Codify will deliver that through MetaMask. But
oh, looks like we lost him. I don't know if that's on my end.
Build those same functionalities into their own software, and Codify, for instance, could package that up and make it available in Quorum for enterprises, for private networks or hybrid private public networks that can also connect to mainnet. So Quorum is very soon going to be available as a managed service on a huge
Oh, looks like you with us, Joe. Your connection was breaking up a little bit.
Oh, sorry about that. Are you hearing me okay?
Yeah, yep, you're good now.
How much should I repeat the whole last 10 minutes?
No, it was just the last few seconds there.
Okay.
But it sounds like you're building a pretty interesting, like you said, a full stack of suite of services, and I hadn't realized exactly how actually MetaMask sits on top of all of that. But maybe we can jump.
MetaMask's mission is essentially to be the most secure wallet for consumers. It's also got a plugin system, so it's a B2B2C platform where other protocols and products can get exposure to MetaMask's users. And via mobile, it's a browser. So it's really going to be a next generation way to access applications on the internet. So no more sort of insecure password patterns, and you can granularly authenticate yourself to a DApp or website via essentially public key cryptography, where you're just signing a message rather than sending over a password.
Great. Yeah, I mean, the whole what Web3 enables in terms of identity and logon and single sign-on kind of concept is, I think, not fully realized yet in terms of what that's going to mean for user experiences, and especially if as actual identity primitives start to come out, it's going to get pretty wild. So maybe we can switch now. I mean, the point of this talk is to get into the future of DeFi, right? And so, given your seat at Consensus, I imagine you're speaking with regulators from around the world. You're speaking with governments from around the world, large enterprises around the world. And I'm wondering from your seat specifically, how are those conversations feeding your mental model of how the future of DeFi might take shape from a regulatory perspective? This doesn't have to necessarily be DeFi. It could permeate across all of crypto, let's say, but some believe we'll end up in a binary world, right, where things will get segmented because of regulation. So you'll end up with a walled garden with KYT wrapped around contracts, applications, assets on one hand, and then you'll have this more kind of decentralized, lawless, meaning less law, not necessarily totally rogue, but this more decentralized, open but rogue DeFi ecosystem that somewhat sits outside of certain state jurisdictions. Do you see that happening, this real black and white separation? Or do you think that these things are going to converge? It won't be that strict of a separation. There'll be some segmentation, but it won't be that bad. Or do you see other segmentation happening, somehow crypto segmenting by geographical, East versus West, DeFi versus Web3, and so on?
Yes, it's very complicated.
Yeah.
I'll take a couple stabs at it. So in the United States and in other parts of the world, with respect to securities, regulators were slow to reduce uncertainty for issuers of tokens. But eventually, in the United States, they applied the rules and they caught up and they understand the technology, and they're doing a pretty decent job. Some would argue, but in my opinion, at least at Consensus, we felt comfortable that we knew how to operate, and we've been able to understand roughly how the SEC is thinking, and we've been able to issue tokens, and it's all gone very well. So securities issue sort of sorted out. Where it gets really complicated is when human beings send value to other human beings, because certain actors around the world who are in power want to know source and destination down to the human being, and that's perfectly reasonable. As a person, you're subject to a certain jurisdiction with those rules, or as an organization, you are. And so applying that to the gateways to our ecosystem, exchanges, also seems pretty reasonable, because those gateways are using Federal Reserve tokens and are subject to those systems, or other state issued tokens, and are subject to those rules. And even if an exchange is sending to an address inside our ecosystem that's say a non self-custodied wallet or non-custodial wallet, it seems pretty reasonable to me that those financial institutions effectively have to play by the rules of more traditional financial institutions, Mnuchin's suggestions seemed not too far-reaching, not too invasive. If you get into a situation where FATF wants every human being to be a financial institution, essentially, a VASP, and report on their their transactions, report on their neighbors, then you start moving into a world where it's essentially like a social credit system in America. And I don't see democracy or capitalism being suspended. I think in order to implement that sort of thing, well, it's just not implementable. It destroys the system, and regulators don't seem to understand that yet. So there simply has to be some sort of understanding that certain rules apply to systems that are nation state systems, and certain rules can't be applied in a non-nation state system. So maybe some citizens of those nation states are using those systems, and maybe some businesses are too, and maybe you can regulate those businesses, but regulating the technology gets really messy, potentially regulating uses of the technology. So maybe you're right, businesses could potentially be regulated, yet if you stand up an organization that isn't a company domiciled in any jurisdiction, which is now very possible in the form of a DAO, I don't know how, who regulates that.
Right.
So that's going to be fun. Bottom line, we're moving into a world where we need to focus on education. So things are cracking up politically, economically, financially, and we are in the early stages of a paradigm shift. It's a paradigm shift in trust. It's a paradigm shift in how the global financial infrastructure is built and operates. And it's a very powerful new technology that has the best interests of humans in mind, as regulators do, I think, in most respects. And we need to have discussions with regulators in different places and try to understand how they would like the technology to fit in their political philosophy, the political philosophy of their nation state. So my thesis is that decentralized protocols are like the United States of America of the next few hundred years. It is they're significantly about free markets and democracy.
That's very well said. And yeah, I think to your point, education is critical. I mean, it's something that we at the DeFi Alliance are trying to do our part. We have a regulatory task force. There's other great organizations like the Blockchain Association and others that are trying to do their part. And of course, Consensus as well, and you yourself as an individual. So, we still live in a meat space world and are, subject to those laws and subject to the people behind them. And so we need to do our part. So sticking on the future theme, I'm going to ask a question. You might maybe not like the framing of it, but let's fast forward 5, maybe 10 years, and DeFi has failed. And you can take failure to mean whatever, DeFi specifically, or just somehow cryptocurrencies or their networks. How or why did it fail? I think at this point it's pretty hard to imagine, but is it because there was too much friction? Is it because regulators just became too afraid of it and tried to clamp down? Is it a lack of privacy, cascading failure, or what? Now, you can say, hey, this isn't going to fail. That could be an acceptable answer. But imagine that it does. In other words, what do you see as the biggest risk or the thing that we should be paying most attention to?
Yeah, so I just I don't see it as a reasonable premise. If we suspend free market capitalism, if we suspend democracy and free speech, and in order to do that, we're going to have to shut down the internet, then yes, maybe you can stop DeFi. But it's just such a good set of ideas. It's so necessary for the moment that we're in. We are at the end of a 70-year debt super cycle, and we need a new monetary regime. And mean, the as all of you out there are aware, the technology is already evidencing that it's going to be orders of magnitude better, stronger, faster. Certainly, it'll be very rough around the edges, and it's going to take a while for the consultants to extract their fees for helping harden systems. Basically, that the hackers will, in conjunction with the builders, build layers and layers of hardened financial infrastructure. How can DeFi fail in that context? Just trying to think of any failure mode.
Yeah, that's an acceptable answer.
Yeah.
If you can't think of one, you know, on the spot, then maybe that's you know, portends well for everyone. And to your point, it's not so much of, you know, it's a function of, like, the cat's out of the bag at this point. And
it's so I guess think about it this way. The regulators can make the technology illegal, can make owning a crypto token illegal. You can create a lot of fear, but there's still going to be so many people in jurisdictions where it's illegal who continue to practice the dark art of decentralized protocols, or who move to jurisdictions that are more friendly. Cryptography is a nice tool. With respect to privacy, regulators are going to have a difficult time tracking things down. And I think the bottom line is that when is the last time that a disruptive technology has failed? It takes a little while, it's slow, it's kind of crappy to use for a few years, but eventually it gets orders of magnitude better than the technology, the system that it disrupts. And so this will be the same.
Right. So we're on the last couple minutes here. So I'll end with you know, a question that's maybe a little bit more personal, or and speaks to some of the founders in the audience today. You know, you've run Consensus for, you know, several years now. You know, it's the largest, probably the largest blockchain, or at least, you know, certainly Ethereum software and infrastructure company. What have you learned as a founder, and like where do you focus most of your time nowadays, and what do you look for in founders? You know, you guys work with a lot of companies and startups, and you have an incubator. You know, you incubate your own ideas, and so yeah, what have you learned? You know, what do you do most of the day, and what do you look for?
So we're a very unusual company. We developed organically from pretty much from right at the start, and so we've been different kinds of companies. A year into the Ethereum project, I started Consensus to just try to figure out what decentralized applications were and how to wrap companies around decentralized applications, even if that was even viable. We've gone through extreme boom periods. We've gone through very difficult periods. The most general thing so we hired the best and the brightest and philosophically aligned people that we could at every stage, and we continue to do that. Probably the best advice that I could give at any stage is focus on structurally on helping all of your people to be happy, to grow, to essentially have a people and talent organization that makes people feel safe and makes people helps people be excited and enables people to grow and have lateral freedom and vertical growth. And it's not at all about money anymore in terms of creating a business or funding a business. As you all know, we can create our own magic internet money. Snap your fingers, basically. You can create $1 billion launch protocol. But the real war out there right now, the real scarce resource is talent, ideas, ability to execute. So hire the best people you can, and do your best to make sure that everybody gets along well and respects one another.
Excellent. Well, thank you, Joe. I think this was pretty enlightening, and certainly interesting future ahead. Like you said, it's not something that's going away, and it's up to everyone here to build and educate and further this whole thing. All right. Well, Joe, thank you. I don't know if you have any last words, and if not, I'll turn it over to Imran, and we can jump into the demos.
No last words. Thanks, Jacob.
Great. Imran, over to you.
All right. Now we're going to get to our actual days with some of the startups that have been part of our program. The way it's going to work is I'm going to play a video. It's a 3 to 5 minute pitch video along with the product and the liquidity mining program offering. And then after that, you have a chance to ask the founder questions. Feel free to post a question in the chat group. I will start with Barnbridge and work ourselves down. If you have any questions, again, please feel free to drop it in the chat. I will now share my screen and play Barnbridge's video.
Hello, everyone. This is Barnbridge. My name is Akeem Sawyer. I'm part of the core team, and I lead up strategy and partnerships. Global debt markets are in the midst of a yield crisis, and there's over $18 trillion of negative yielding debt out there. Barnbridge is the best way to gain yield exposure into DeFi. We're a tokenized risk protocol. We allow you to manage your risk exposure across a number of variables and across platforms. Our initial focus is interest rate and price volatility. And we recently launched our first product called Smart Yield, which gives you the ability to manage and transfer risk within a singular pool. So on the senior side, you can lock in a fixed rate return, and the juniors get more variability to the upside and downside of the underlying rate asset. Smart Alpha bonds will allow you to manage your risk exposure to price. So you'll be able to set what kind of price exposure you want to the underlying asset. Since our launch in November, we have currently today about $430 million locked in total value. We have $36 million worth of liquidity on Uniswap, close to 6,000 token holders, and over 800 wallets that are staked and participating in governance. The majority of our tokens today still sit in the treasury and will be used to build out the network and continue to expand our product suite. Here's an overview of our core team and our key partners who work with us day to day. And the liquidity provision opportunities are really primarily with the product into Smart Yield on the seniors and junior sides. The seniors essentially allow you to enter a pool and print NFTs, and the junior standards are built on ERC20s. So you can print junior tokens and you can trade them on any venues that have liquidity in those tokens. And you can still today provide liquidity into our Uniswap pool, which is incentivized by bond tokens. I'll give a quick product walkthrough. So Smart Yield, here's the first page you see when you click through the app. You can see it gives you an overview of markets. Currently today, we launched with Compound with a USDC stablecoin pool. This gives you an overview of how much liquidity is on the senior side, a sense of the current APY, what you can get in terms of liquidity on the junior side currently sitting in there, and the junior APY. If you click on deposit, it takes you to a deposit page where you can decide what side of the pool you want to enter. If you click through the senior tranche, you get a little bit of a warning and some details. Click through and you get into our docs, which give you an overview of the product, details around how it's structured, and also the fees and every detail associated with the product. When you click the next steps, you go into the deposit tab page or view, and this is where you enable the token. You can choose the amount of funds you want to deposit. You can choose the duration and maturity date. And at that point, it will publish the guaranteed APY you can lock in. And going back to here, you can do the same also for the juniors. Slightly different because here you just put in the amount you're trying to deposit, and you'll get information on the fees, and you can make that deposit based on the rate that's published. So quickly, I'll just go over some of the rest of the app. Here's our yield farming page. You can see the TVL, the current rewards that have been doled out relative to what's in the reward pool, a summary of the pools themselves and the current TVL and balance and the makeup. You know, some charts and stats to show you how the pool has behaved over a period of time. You can click through and see how the Uniswap pool has behaved in terms of deposits and withdrawals, and a summary of most recent transactions fees. And lastly, I'll show you our governance tab. And what I want to emphasize here is a proposal system. We currently have a proposal that is going through voting, and this is to incentivize the junior tokens in the Smart Yield product. You click through and kind of describes at a very high level, you know, the actions that are going to be taken through this governance vote. If it passes, you can have a link to a forum where the initial proposal was placed in and discussed. And once the vote goes through, anyone could basically activate it, and all these actions basically get added to the smart contract and go on chain. So thank you very much for your time. Here to answer any questions you might have. Thanks.
Awesome. Any questions for Barnbridge or Akin? The first question is, how do you compare to Saffron?
I haven't really spent too much on Saffron's structure, but we're quite different in terms of the construct of our pools and how we actually define the model that supports those pools. So with Barnbridge, it's a singular pool that's derived right from the underlying originator. And the pools are set up to essentially build on each other. So as more, for example, users enter the junior side of the token, it raises the guaranteed rate that a senior gets exposure to, right? So it's sort of like transferring risk from the senior side of a singular pool to the juniors. And the juniors are basically ensuring that fixed rate return for the seniors. So I think we'll differ quite a bit in terms of the model and actually the underlying formulas that drive how those pools are composed. And we're also sort of more focused on sort of like at least in the interim, like the higher and safer side of the marketplace, where we think there's a large amount of TVL and the security infrastructure is sort of tuned to the customer base we're going after, which is sort of a mix between DeFi or current DeFi degens and new TradFi users coming into the space.
Awesome, Akin. Thank you so much. And feel free to answer questions via the chat. I'm going to start our next presentation with PrimtiveFi and Alexander. So we'll be sharing the video here shortly.
Hi, everyone. I'm the founder of Primitive, an options market protocol built on Ethereum. We're at the Primitive app right now. These are the available markets that we have for Rapti and Sushi. Going into this market, we can see the available options for traders to buy and sell. Traders can buy calls or puts. And when they do trade these options, this will be generating trading fees for the liquidity providers of the system. We can go to the liquidity tab, and this will show all the different liquidity pools for each option that we have. So we have liquidity pools for both calls and puts. Notice the put liquidity pools are denominated in DAI. This is because all put options use DAI as collateral. So we can both add underlying assets to the liquidity pool as well as collateralized options, which are also put into the liquidity pool. When you add liquidity, you're only adding the underlying asset as liquidity. So for example, we can add one sushi, and this will deposit it into the pool. What happens is when traders come to trade options, they're going to be using this liquidity to take on some position in whichever direction they want. And when they do so, they are generating trading fees for your liquidity that you put into the system. Now, this uses Uniswap and SushiSwap in the background. I'm sure a lot of you are familiar with how these AMM pools work. Usually, these pools use a 50% underlying asset to like a stablecoin. Here, the return profile is a little different. When you are a liquidity provider in these option markets, you are effectively holding the underlying asset and earning trading fees entirely on the underlying asset, unless the option goes in the money. Take, for example, this sushi $30 call. If sushi reaches the $30 price, this is when your return profile changes as an LP. If sushi never reaches the $30 call price and the option expires out of the money, and if you deposited one sushi, you'll be able to remove exactly one sushi plus all the trading fees that were generated. Now, in the opposite case, if sushi goes above $30, what happens to your liquidity position is effectively half of your deposit is sold to stablecoins. This is a graph of what happens to your stake, effectively your provided liquidity, depending on the change of the underlying asset's price. Now you can notice here the black line is the primitive return profile. The gray line is holding the underlying asset. And then the pink line is if you were depositing 50% of your stake as ETH and the other 50 as USDC to a Uniswap pool. Some of the first options we've deployed on primitive are very out of the money. For example, this Ether option expires on the 24th of September at a 5,000 DAI strike price. So for most of these LPs, they've deposited 130 ETH effectively. If Ether never reaches that price by September, they're going to be withdrawing all of their ETH back, plus all the trading fees that have been generated. This is what primitive is in version 1. So really there's customized return profiles that have a better risk-adjusted yield when compared to some of the other options that you might have. But we do not have a liquidity mining program for V1. Thank you.
Any questions for Alexander with PrimtiveFi? Alexander, do you want to say a few words or talk a bit about the comparison between what you're building and Hedgic?
Yeah, that's a good question. There's a big difference. So as an LP in Hedgic, you are the counterparty to the options that get written. And in Primitive, you're not the direct counterparty. Actually, when you add liquidity for the first time, you start neutral to the option. And then over time, you might pick up exposure in either direction opposite to which trades go.
Cool. Thank you. We'll be playing our next video, which is Ribbon Finance, and then we'll have Julian come on and speak. For anyone that has questions about PrimtiveFi, feel free to drop it up in the chat, or you can contact him directly.
Hi, today I'll be talking about Ribbon Finance, which is a new protocol for creating crypto-focused structured products. So the structured products industry is sort of this really large $7 trillion market. It is highly regulated. It's mostly created and sold by banks and other institutions. We think it's sort of pretty ripe for disruption, especially on the retail side of things, because that is sort of the group that has never had access to these types of products. On the other hand, a lot of new derivative protocols are coming up every single day in DeFi, and it is sort of becoming mature enough that we can combine these derivatives to create really interesting products for people. Yeah, so we think by composing all these derivatives together, it could be a very interesting value proposition and potentially killer app of DeFi. So there are four main categories that we are trying to target, namely volatility, yield enhancement, principal protection, and accumulation. So a month ago, we actually launched the first multi-protocol Strangle option on Ethereum. So this Strangle was constructed using two different options protocols on Ethereum. It used a put and a call from two different protocols and combined it together into a single product that users could buy with one click. So that's sort of just like a glimpse of what kinds of products we want to build for people. We are launching our flagship product in 2 weeks, which we call Option Vaults, which is basically a way to create automated option strategies on chain. So how it works is as follows. A user deposits ETH into our vault. Our vault mints these call options and sort of sells them to market makers, earning a premium. Over time, these premiums get reinvested back into ETH, and the depositor would sort of grow their ETH over time. This is like a very simple, traditional covered call strategy. But if you sort of tell 90% of people to go run a covered call strategy on their own to earn yield, most of them won't know how to do it. So we are creating a way that users literally just have to deposit ETH into our contracts. We think this sort of opens up an entirely new type of yield in DeFi, which is what I call industry grade and sustainable yield. Most of the yields currently in DeFi are sort of driven by farming tokens, dumping tokens, all sorts of short-term incentives. But so if we look at the traditional finance world, covered calls are like a very, very common way for people to earn high yields on assets. And we are sort of the first to do that in DeFi. We did a backtest of this vault that we're trying to create. And even throughout like the whole, from 2020 all the way till 2021, we have shown that, yeah, this kind of strategy is actually pretty lucrative. It can outperform ETH, and sort of over the last year, if you outperformed ETH, you did tremendously well in USD terms as well. So we are sort of building a whole universe of these option vaults, not just a covered call strategy, but for example, an ETH version of that, a wrapped Bitcoin version of a covered call strategy, a put selling strategy, and so on. Eventually, we think we'll get to a stage where we can have user generated strategies, which is sort of where it gets really interesting. So back to how our system works. When one of these vaults sort of mints these options, it has to sell them to market makers. So currently we are working with a few market makers to sort of buy these options from us. As we sort of create more vaults, this sort of demand for selling off these options would keep increasing. And we are looking to partner with market makers who can sort of scale with the size of our vaults. So for example, we think if these vaults sort of grow to 100 mil TVL or $200 million TVL, we would sort of be selling each of these vaults would be selling sort of $200 million notional of options every week. And we are looking to partner with the largest options market makers who are able to sort of buy this, to trade this size. We think it's pretty lucrative. Retail is generally not super price sensitive. So I think market makers who are early to our platform would be able to get a pretty good price on these options. Yeah, and that's sort of how we plan to grow these vaults. We don't really have a liquidity mining program yet, but I would love to chat with anyone who trades crypto options in size and could be a good fit for our protocol. Yep, that's it. My email is julian@ribbon.finance, and I'm happy to answer any questions. Thanks.
Great. Any questions for Julian? And maybe Julian, if you want to give a few more words on kind of like your V1 and some of the additional details on partnering with market makers.
Yeah, I think I just want to say, come into our Discord. We are always discussing new types of ideas for new products, and we are launching our first ETH vault on the 12th of April. So yeah, if you want to be updated on that, feel free to follow us on Twitter or just join our Discord.
Awesome. And if you could drop your Discord link in the chat and your website.
Cool. Yep.
Awesome. Thank you. Next we have is Zerion. And we'll be playing their video shortly.
Hi everyone, my name is Injective Labs. I'm the co-founder and CEO of Zerion. Zerion lets people invest in pretty much any kind of DeFi assets from a single application, as well as to track the performance of essentially anything within the DeFi space in your portfolio. So let me quickly dive in how Zerion currently works and how it helps people explore and invest in DeFi assets. So as you probably know, the DeFi space is inherently complex. So we're now probably approaching about 100 meaningful protocols in the space, all of them range in complexity and the way how people interact with all of them. So that creates a bunch of issues for the end users. Essentially, they are not able to precisely track their DeFi portfolio as the first aspect of it, as well as make sure that they are on top of every DeFi opportunity in the space. So what Zerion allows to do is first, it tracks your full DeFi portfolio. We started with the Ethereum chain, but now we support Binance Smart Chain, Matic Network as well. And we're moving to support more and more DeFi protocols and assets over time. It also allows you to explore pretty much every DeFi opportunity, ranging from all kinds of liquidity pools, deposits, all the way down to vaults and staking opportunities as well. And lastly, we act as an interface that abstracts away the complexity of protocols like Compound and Maker, so users can borrow and lend money directly on Compound and Maker through the Zerion interface now. Just to give you a sense of how Zerion has exploded in the past year. So we started in 2020 with about, I think, 5,000 monthly active users. We're now at over 150 total monthly active users, and our mobile offerings are growing as well. So from the volume perspective, we've been doing just over 10 million in December, and in February we already approached 100 million mark for the trading volume, and that number is still growing. So that should give you a sense of like how Zerion has been evolving, and it definitely finds its product market fit in portfolio tracking and also abstracting away the complexity of DeFi protocols. Just a few words on how Zerion currently works. So Zerion essentially consists of three main components. One is the DeFi SDK, second is the Zerion Bail Layer or Zerion backend, and lastly, our client applications. So all the protocols, they connect to the Zerion through the DeFi SDK via adapters. So adapters are all on-chain as well as the DeFi SDK, and Zerion Data Layer just fetches all the information from the DeFi SDK as well as other sources and compiles that in format that can be represented by our client applications. Our API is also available for external users. So if you're looking to get data that Zerion has and you want to include that data in your application, talk to me. So I'm happy to extend the API keys so you guys can have it all in your app. And a few words on trading on Zerion. As I said before, we're now doing over 100 million monthly trading volume. We source liquidity from many different dexes, pretty much all dexes in the space, ranging from native support for Uniswap, Curve, and the like, all the way down to 1inch and DRX as aggregators in the space. And to point out, we don't charge any extra fees on top of that, and we don't add additional gas costs to executing these transactions for the end user. With regards to trading and in terms of help we're looking for, we are looking to work with market makers who are already working on an RFQ system. So if you can quote users better than 1inch, for example, Uniswap, let's speak and let's make it work together. So we already started integrating with one market maker and planning to expand that offering so we can provide better quotes for our users. And if you are a protocol in the space and you're looking to integrate with Zerion and Zerion for some reason doesn't support you yet, you first can definitely reach out to me directly, or the first thing you can do is go to docs.zerion.io that has an extensive guide on how to create your own adapter for the DeFi SDK. That would significantly increase the speed of the integration, because from that point, we'll just need to enable that within our system, and that should work right away. Thanks again. And excited to work together with you guys. Here are my contacts. Feel free to reach out and enjoy the Liquidity Demo Day. Bye-bye.
Great. Jenny, quick question that I've received from the audience is, how do you think about layer 2 integration? And how do you think about expanding to the offer like cross-chain swaps, things like that?
Yeah, so first of all, thanks for everyone sending some love in the comments. Speaking of layer 2s, this is definitely in our pipeline for this year. So we're planning to add pretty much for tracking purposes, we're definitely going to track pretty much every protocol in the space. That's at least the goal. In terms of actual transacting through, we're still deciding on which one we're going to go first. But this is definitely something that we're looking at and focusing on.
Awesome. If you want to drop your contact information in the chat, and there are going to be a few more questions that will be coming up on the chat as well.
Yeah,
all right.
For sure.
Thank you so much. We'll go to DFX with Kevin. We'll be sharing my screen here shortly.
Hi, I'm Kevin, and I'm here to present DFX, the Decentralized Foreign Exchange Protocol. So DFX is an automated market maker optimized for low volatility FX trading. So you can think of us as a cross between Uniswap and Curve. We leverage stablecoins to settle different types of currencies. So we work with different stablecoin issuers around the world to tokenize different currencies and put them on DFX. We consider ourselves a fiat on-off ramp. We aggregate different stablecoin issuers and fiat on-off ramps for these different stablecoins. And what we're really trying to build is a global entry point into crypto. So our value proposition is really our unique automated market making design, where we get to optimize and specialize in FX trading. So we use an Oracle powered by Chainlink to bring in FX price feeds from the outside world on chain and optimize for capital efficiency. We provide retail users with institutional FX pricing. So generally pricing that you would reserve for multi-million-dollar trades, we can actually provide to retail users doing trades of like about $100. We also remove currency risk for people in DeFi, where right now 99.9% of stablecoins are really denominated in US dollar, and there really is no other option in terms of de-risking off of the US dollar and using their own local currency. So we are going to change that. So how does DFX work? We use USDC as sort of like a bridge currency across all our assets. The USDC is placed inside each one of our pools and is used to facilitate trades between different currencies. If you're just doing a US dollar trade to, let's just say, Canadian dollar, you only have to do one swap. But if you're doing a Canadian dollar to a euro trade, what happens is actually route through USDC through our pool that you're essentially doing 2 swaps in our router. So our unique bonding curve is what separates us from the competition. All else equal, we would almost always beat Uniswap in terms of pricing in FX trades, because our unique Oracle-based design lets us optimize our bonding curve for each currency through back testing. So that allows us to minimize slippage, optimize capital, and maximize utility. So I will show you a quick demonstration of how that works. So what we have here is a demonstration of what our curve could be. So this is the purple one, and the green one is actually what Uniswap uses today. We have a bunch of different parameters that we can actually pull that would actually optimize and make the curve unique to different currency pools. And what we do is actually we backtest the data with historical FX data to optimize that curve for each currency. So if we change our beta to 0.9, this becomes a flatter curve, allowing us to optimize for trades for currencies that are significantly lower volatility. If we have currencies that are slightly more volatile, we can make it a little more rounded, closer to like Uniswap, but we would almost always beat them in price because of our flat region in the curve and how we optimize it for this particular currency. I'm going to go into liquidity mining and what we offer. So currently, we have 3 pools. We have a Euro pool, a Canadian dollar pool, and a Singapore dollar pool. These different tokens are issued by our partners in these respective countries, all regulated and fiat-backed currencies. Option 1, liquidity provisioning. So this is your standard yield farming, providing liquidity on-chain through our liquidity pool, where you would earn DFX tokens and swap fees in the protocol. What you do is you buy these foreign stablecoins through our stablecoin issuer, that you deposit them into our DFX pools, stake the LP tokens, and then you wait. So this is a passive strategy, very good for low risk yield. We're anticipating anywhere from 10 to 100% APY, like variable API per year. The second option is a more active market making strategy where you can arbitrage between our pool and the traditional FX world, where you would still buy these foreign stablecoins through our stablecoin issuers. But what you would actually do is actually arbitrage between real world FX prices, and you would have a leg in the crypto world and a leg in the traditional financial world, and you would make sure the prices match. And if they don't, you have an arbitrage opportunity. So our roadmap, we're launching our V1 version of our automated market maker in about 6 to 8 weeks. We currently right now have 3 foreign stablecoins, but we're looking to increase that number significantly over this year. We have about half a dozen lined up for our V1 launch, and we will continue to onboard more throughout the year. So this is a fairly simple application right now because we only have our liquidity mining up. Right now we have about $30 million locked up in our 3 pools, each of them with roughly $10 million in the pool. So we can facilitate trades of anywhere from a couple of dollars to like multi-million-dollar trades with significantly low slippage with our current pool size. Okay. And that's it. Thank you for your time.
Great. Any questions for Kevin? A question from the audience that we received is, which non-USD stablecoins are the most likely to take off?
So you're probably going to see a lot of interest in the euro as the US dollar weakens and people are looking for other currencies. And the euro is probably the natural one that a lot of people gravitate to. But where we see a lot of demand for sort of like a product like ourselves is probably in the emerging markets, where a lot of money gets like remitted from one country to another. There's a bigger need in terms of like a DFX product because like the traditional system just don't offer services and rates anywhere near good enough for what those people need. So we're actually targeting countries in Southeast Asia, Africa, Latin America. We think those are the most optimal markets to tackle early on. But really, our coverage is global, and we want to get into every currency available.
Got it. Any other questions before we move on to DFX or to Swivel? Cool. Thank you, Kevin. And Kevin dropped his Discord information here and website, so feel free to join his Discord and follow him on Twitter.
Thanks, guys.
Thank you. Next startup is Swivel Finance with Julian. Go ahead and play his video.
Hey everyone, I'm Julian from Swivel, and I'm here to give you guys an introduction to our protocol and its mechanisms, as well as the baseline incentives and more recent efforts we've put into improving the user experience and market dynamics for liquidity providers. Swivel is a peer-to-peer interest rate derivatives protocol that is designed first and foremost for professional traders and liquidity providers. With Swivel's first product, we've attempted to balance the incentives of risk-averse lenders seeking guaranteed cash flows and opposingly risk-tolerant speculators and risk-averse borrowers. These opposing incentives then allow for direct arbitration of our lending rates. However, in order to ensure capital efficiency is reasonable and positions can be placed with precision, we then utilize a combination of an off-chain liquidity aggregation network and order matching engine. The most direct comparison, I suppose, would likely be the 0x protocol and 0x mesh. We offer both a basic market order interface as well as a professional trading interface that has integrated most standard features necessary for high precision analysis and execution. In order to then assist with technical integrations, we also offer JavaScript and Python SDKs, which provide access to our basic contract and exchange functionalities. Moving on to our protocol rather than our exchange, Swivel's first product is something in between a swap and a strip. One side pays a premium for an interest coupon, while the other receives the premium in corresponding zero coupon bonds. The result is that one party is given access to significant money market leverage, while the other insulates their risk with a fixed yield. An alpha build of our protocol is currently live on Kovan. However, our mainnet release has been reworked to significantly improve both the experience and market dynamics for liquidity providers. With our mainnet release, maturities will be fixed and all positions will be fungible, allowing users easy position entry and exit. This change is integral for many participants within our market, particularly liquidity providers and protocols looking for easy interoperability. Further, if these maturities are then synchronized with other fixed rate protocols, this change can then enable an entirely new market of users neutralizing their risk exposure across protocol. Most interestingly, this provides the potential for arbitrage of yield origin. Given all other live zero coupon bonds source their yield directly from borrowers, while Swivel sources yield from interest rate speculation and money markets, arbitrageurs may find inefficiencies that may take years to resolve. As for a walkthrough of our alpha, the simple application is just what most users might expect. On one side, a user can input their principal and easily lock in a fixed rate. Whereas on the other, a user can input the amount they would like to commit and lock in a given amount of leverage. Alternatively, if a user would like to place limit orders on our order book, they can utilize our professional interface. It has most features expected of an exchange, with the primary differentiator being rate has replaced price. A user can come to the order book and place an order for a given amount of principal at a given fixed rate, or alternatively can put up a given amount of collateral for a given fixed rate, receiving a given then amount of leverage. This allows both sides of the order book to have their given incentives expressed and then easy arbitration of the current market rate. In order to attract liquidity, we have reserved 50% of our governance token supply for baseline maker incentives. Given these are baseline to all users, this means that any order that is filled will be rewarded weekly for its proportional liquidity provided. We hope that in doing this, we incentivize more novel retail market making, of course leading to reduced slippage and spread, but also most likely revealing additional opportunity for sophisticated market makers. Beyond our baseline liquidity incentives, we also plan to sponsor a professional market making program. While the numbers shown are just rough approximations, the mechanism of our program is likely familiar for most market makers in the space, as it is based on Hummingbot's 2019 paper, which a few other protocols have already adopted. We've got a great team with experience across the best of traditional finance and Web3, and are hoping to find capital and conceptual support to ensure the health of our early markets. If you'd like more information or interested in our mechanisms or liquidity program, please just get in touch with me at juliant@swivel.finance or reach out through DeFi Alliance. Thanks everyone for your time.
Great, Julian. We have a question. The first question is, give us a little bit more color on how the money market leverage is achieved.
Okay, so I'd say we definitely have a bit of an interesting dynamic in terms of how we set price. And essentially what happens is one user is willing to pay effectively an 100% maintenance on their leverage. But what they get is a variable amount depending on the rate that they give out. So let's say you're willing to back a rate at 5%. Effectively, then what you're getting is access to 20 times that in leverage, right? So the equivalent would be someone has $1,000 in principal, wants a 5% rate, you give them $50, but what you get back is a vault that then has $1,050 in CUSDC in it. So effectively then, as long as you own that vault, at least you're gaining all of the interest that would have otherwise been going to the first party. Yeah, and at that point you're getting, above 20% leverage. Yeah, it's pretty cool.
And another question is, what are differences between Swivel, Yield, 88 MPH, and some of the other?
There's a lot at this point, right? Yeah.
Pick one, Yield, and then maybe talk through that.
So Yield, I think, is really interesting. And this is more just a pretty easy to understand zero coupon bond, right? Where you take some amount of collateral and you then just mint zero coupon bonds and can sell them on an open market. So on buying them on that open market can then get access to a fixed rate. So then really what you have there is someone is fueling this fixed rate directly with borrowing liquidity. Whereas for us, we're not offering borrowing at all. And as well, involved in this process, that means that we don't actually have to track any sort of collateral. And at that point as well, don't even need to necessitate any sort of liquidations. So, I mean, we do claim that we're supposed to be safer. Who knows how much people will care about that? But beyond that, I mean, there's a big difference in terms of how we're actually sourcing yield for our fixed rates. Yeah.
Got it. Thank you so much.
Awesome. Thank you.
Next up is, and feel free to drop your Discord, Telegram, website, the whole 9 yards if you haven't done it already. Thank you. Next up is John with Seasons, which is a NFT protocol. We'll share that here shortly.
Hey folks, I'm John. I lead product for Seasons, which is a platform for user-curated NFT funds offering liquid and fractionalized ownership. And ultimately, we want to enable everyone to become art curators and investors. And curation here is in particular important, which I'll focus on in a bit. But in terms of the opportunity, we're all aware of NFTs grabbing the world's attention. I'm personally super excited about NFTs, not only because I love collecting them, but because I see it as the first meaningful application of crypto where mainstream is able to both wrap their heads around and be excited by the core concept, which in this case is provenance. But despite all of the excitement and the new number of participants coming into the market, NFTs have some certain challenges where for collectors, only the super rich can have meaningful ownership of highly sought after NFTs. For investors, investors are limited in terms of options of how to get exposure to the NFT market, where usually they would need to just simply do research and take bets on specific NFT pieces. Now with Seasons, it's possible to invest in NFT curators and a curated set of NFTs, much like how you would invest in a good fund manager or an ETF for exposure to a basket of equities. And not only can investors invest in our curated NFTs and NFT curators, anyone who believes they have an eye for being able to identify appreciating NFTs can try their luck in hand and let the market determine whether that is the case. And of course, with fractionalization, anyone can own a piece of the next Mona Lisa. And by allowing anyone to create an index fund of their own basket of curated NFTs, we believe we're allowing for a better price discovery model by not having to reduce these unique and NFT pieces into fungible assets, rather letting the market determine the price based on the uniqueness of that NFT. In terms of what a UI might look like, which it will, our MVP will look much better than this, but this will give you an idea of what the experience is like, where a user comes into the platform, is able to see a set of curated funds. Some of them will be featured on Seasons, where somebody like G-Money has a reputation of being able to select great NFTs, and they would be able to see which NFTs are in the fund and be able to partake as owners and investors into the fund. And of course, they can go and create a fund for themselves and be able to offer it for investors. In terms of some exact details of that implementation, when somebody creates a UCF, they set certain parameters like the name, token supply, percentage of the tokens that they are selling, sale price per token, as well as the duration of that sale. Once the sale is complete, then we introduce a means of an additional liquidity for that token by allowing them to create pools against the Seasons token for further price discovery. And the NFTs are locked in the contract until a buyout happens. These are the mechanisms for the buyout, and perhaps in the interest of time, I can cover that in a Q&A. How do we capture value? Every single UCF that is created sends 1 or 2% of the UCF tokens into the Seasons treasury. So at a minimum baseline, Seasons is worth 1 to 2% of all the funds created on Seasons. And that parameter is one of governance, so that Seasons token holders can decide what is the most optimal fee. We like the value accrual mechanism that Bancor and Rune kind of highlight. So we aim to incentivize pools of UCF tokens against the Seasons token, while users will be able to create pools against other assets as well, should they decide. I'll skip this, but in terms of the liquidity mining program, we aim to launch the token on April 7th and let the token have some price discovery so that when UCF tokens are paired against Seasons, users don't face significant impermanent loss. But yeah, it'll be a 4-week reward period for both pool 1 and 2. And we are currently targeting about 22 million out of the 365 million total supply to be distributed during this initial period. And yeah, thank you for your time, and we look forward to answering any questions. Yeah, bye.
Great. We've had a couple questions come up. Maybe we could start with what's the difference between what you're building along with NFTX and some of the other kind of fractional protocols?
Sure. I think an NFTX approaches index funds for NFTs quite differently, where because of their redemption model for redemption models based on 1-to-1. So I personally think that it doesn't really capture let's say the price discovery of a particular NFT that somebody would not want to replace 1-to-1 with a random NFT. So the NFTs that exist in the NFTX pool are those that people are simply willing to let go of for a random redemption redeemed NFT, right? So the collection of NFTs in NFTX is by nature different from what you would have from a curated basket of NFTs, which then prices them differently.
Got it. I guess the final question is, how do you think about regulations and kind of working through that?
So we have a pretty good legal team who's helping us navigate through, I guess, making us be sufficiently protected. I think in terms of like regulations for crypto in general, we're all navigating a pretty new space. We are a US-based entity, and because of that, we're taking proper steps to make sure that we can protect ourselves as well as our users. And yeah, we'd like to follow some of the success stories we see from something like Uniswap, for example, and we'll focus on making our protocol as decentralized as possible.
Great. Thank you so much, John. And please feel free to drop your contact information, or if anyone else has questions, please feel free to drop in the chat. We'll have Injective next.
Hey guys, welcome to the Injective Liquidity Demo Day. Injective Protocol is a fully decentralized derivatives exchange that supports the trading of all things derivative, including perpetual swap, expired futures, synthetics, and many more. One of the most interesting aspects of Injective is that it has a fully decentralized order book along with a futures protocol that sits on top of the Cosmos layer. However, Ethereum users can enjoy full composability as well as our EVM layer because of our interesting Ethereum first design philosophy. This way, we can onboard Ethereum users extremely easily, have them migrate a token over from a fully decentralized Peggy bridge and trade utilizing any type of collateral with limitless market access. As you can see, right now on our Equinox staking testnet, where we have already onboarded more than 19 validators with 14 bonded and more than 4 million total INJ staked. As we prepare for mainnet, I would love to show you guys how the Injective exchange works and some of the markets we are currently testing on our testnet. Welcome to the Injective exchange testnet. Here, you'll find all of our markets. If you want to get started, click Connect a Wallet and create a new address. Clicking on the testnet faucet will get you the 100K USDT airdrop. Once the airdrop is complete, it should be reflected on your wallet. There you go. Now let's try out one of the markets. Let's go to INJ/USDT perpetual market. This allows you to trade on 20x leverage. Let's say if I want to go long on INJ, the look and feel of this interface is very similar to most of the centralized exchanges you're used to. Let's say I'm conservative and I only want to go 5x leverage. As you can see, the order is being taken and the position will be updated shortly. I can also place limit order. And let's say I want to do a cross order and place 1 INJ. Since the order is being crossed, that means the position and it's going to be taken right away. So now the position will be 2. Now, if I want to close out a position, it's actually very simple. All I need to do is either place a reduce only limit order or a market short order. For simplicity's sake, we'll just place a market short order for now. There you go. The position will be updated shortly. And now let's go to the portfolio page. Here it keeps track of all of your previous trades, and you can actually actively manage all the positions from across all the markets. So let's say I'm going long on 10x leverage with 2 BTC here. Again, I'm going market order. Now let's see. Once the position is updated, I should be able to go back to the portfolio page and see and manage my position. Here you go. My position is shown here across all of my other markets. And I can actually close the position and manage it right from this portfolio page. And as you can see, I have around $99,000 in total portfolio value. Unfortunately, I'm not that good of a trader. So far, all of my positions have been negative P&L. And that's pretty much it. Hope you really enjoyed this demo and feel free to reach out to me for any more questions. Have a good one, guys.
Great. Eric, a few questions, but feel free to add any more context to the demo and anything else that you want to touch on. Eric, are you there? Sorry, we can't hear you. Cool. We'll go to our next demo, which is with Dodo from Dodo Finance. Play that video shortly.
Oh, hello?
Ah, there you are.
Oh, okay. Yeah, I think someone asked me about what L2 are we on. So we kind of built like our own native like cost plus SDK with, you know, kind of like instant finality plus 1 second block time. And basically it's all going to go through Peggy that we kind of developed as a fork of Alphia. And basically there's going to be a decentralized bridge, and the validator have that responsibility of monitoring the Ethereum state for all deposit managers. So actually Equinox staking, you're actually depositing real INJ and testing out that decentralized bridge.
Got it. And what are the differences between what you're building and some of the perpetual swaps that are out there?
So I think the key difference here is that we're actually fully decentralized with order book base. So you don't really see any other derivatives exchange with an order book infrastructure that has such a fast finality. And you know, a lot of other competing solutions like DYDX and some of the other ones all use like a centralized operator or some form to like scale the infrastructure, which in our opinion is not exactly the safest approach from like a availability standpoint and from like a compliance standpoint.
What's the liquidity like on Injective currently? And
yeah, so right now we're still pre-launch, but we've been onboarding a lot of market makers and actually set up our own like kind of market making arm to ensure that there's liquidity. And since you know, like this is a decentralized platform, we don't have any advantage over anyone else. So it's going to be a fair market for everyone without any type of toxic order flow.
Got it. And final question is, there was an announcement today with Cash. Maybe you want to talk a bit about that?
With who? Sorry.
It was a Cash Alpha. Oh, sorry, that was an older one. Sorry about that. Cool. Anyone else has any questions? There was one final one, which is, will you also be doing an API for other apps to plug into?
Yeah, so there's going to be a trading API. We've worked on this quite a lot with some of the other projects as well. An interesting one would be like Parsec, where you can just like kind of trigger automatic trades basically, and especially with meta transaction, it makes it super easy. And we're also going to be doing a lot of interesting things with regards to the decentralized bridge by kind of like doing what Phantom did recently with Andre Croney's project, where essentially you can do like atomic transactions that lands in Injective and kind of like callbacks to Ethereum, and maybe even withdraw back to Ethereum, all within one transaction from Ethereum.
Awesome. Thank you so much, Eric. If you want to drop your contact info and Discord or whatnot, and we'll have.
Sure.
All right. Final presentation before we have Jim Bianco speak is with Dodo. So let me go ahead and share.
Hello, everyone. Radar from Dodo here. Dodo is a next-generation decentralized exchange focused on capital efficiency and flexible market-making strategies. The platform offers various customizable technical solutions geared towards professional on-chain liquidity providers. Unlike AMMs, Dodo uses PMM, the proactive market-making strategy, to provide liquidity even better than Binance with an incredible capital utilization rate. Dodo's biggest competitive advantage lies in its price curve, and pool creators on Dodo get to tweak its parameters and shape whenever they see fit. This gives rise to a much more balanced dynamic between market makers and traders that is not normally seen on traditional AMM platforms. And here is the case I want to show you. First, this is a pool that's not very big, only 500K total liquidity here, but it generates $10 million volume per day, and this volume brings $5K trading fee per day for the liquidity providers. So you can see there is no farm here, but the liquidity providers can have a very good profit from the trading fee income. And then you can see here the swap records all of them are retail users. You can see that this volume is not from arbitrage, but real users. So how could we get this awesome pool? Because of this magic number here, the get price. The get price is provided by our market maker partners. They just feed the price on chain, and we use our algorithm to concentrate the liquidity near this price. And because of this kind of very, very high, like 100 times better than AMM, we could get profit even with a very, very small trading fee. Here, this trading fee rate is only 5 bips, but we can still get a significant amount of trading fee income. So now what we are asking is not the market makers to provide liquidity, but to provide their price. We could cover all the gas costs of feeding price on chain and even offer Dodo to the market makers who provide the good price to us. And by the way, the program will start on layer 2 first because it is not very efficient on Ethereum because, well, we experienced it for the last few months, but we think that this solution works really well on layer 2, but not layer 1. And if you would like to know more about this and contribute this next generation liquidity solution on Dodo, you can contact us to discuss more about it. Thank you.
Great, and that was our final presentation for the day. We now have Jim Bianco, who will be presenting about just a general macro landscape, along with talking a bit about his thoughts on DeFi and crypto generally. Jim, are you there?
Yes, I am. Can you hear me? I'm coming through to you?
Yes, you are.
Hello, everybody. Thanks for inviting me. By the way, I'm coming to you from lovely Laguna Beach. We should all be in Laguna Beach right now. It's really nice here as well, too. Let me tell you a little about myself. I am a traditional CeFi guy who has been converted and sees the light. And the light is that DeFi is going to be the biggest disruption to the financial services area since the invention of the paper currency in 1693 by the Bank of England. And I'm not being too hyperbolic when I say that, it's going to be a very big deal. But I think all you guys know that. And so I'm not going to go through that, but let me share my screen. I do want to go through a couple of other things that I would like to talk about, because I am a traditional CeFi guy. I want to talk about the things that I see that I think would be relevant for you. So hopefully you can see my screen here. And I've got 3 topics I wanted to discuss. The US economy, because that's my strong suit, is very strong, and what could upset it is a potential COVID wave for a few minutes. The outlook for inflation is higher, and what is causing it is the mailing of money and the emergence of universal basic income. Now, let me stop there and say I'm not against at all helping anybody who needs help, but what I'm afraid of is there's going to be a consequence to what we're doing, and that consequence is going to be the devaluation of the US dollar through higher inflation. And then, since I am talking to a largely DeFi crowd, the biggest risk I see, I'm not going to talk to you about the mechanics of DeFi, you guys know more about it than me, is I see US regulators setting it up so that we're going to sit this out, we being the United States. They're going to tell you that AML and KYC rules are going to prevent anybody from doing anything in this space. And I just wanted to point out that there's 1.2 billion mobile registered money accounts in the third world, Latin America, Asia, and Africa. And they're going to set the standard if we're not allowed to play in that sandbox. And that's kind of where I'm really afraid of. So let me dig into a couple of these things, and I'll try and go about 20 minutes and then take some questions. Let's talk about the US economy. the blue line you're looking at right here is a rolling average done by Bloomberg of what economists think 2021 GDP is going to be. And right now they're thinking that it's going to be around 6%. The dots are the Federal Reserve's forecast. The last time they updated it was March 17th at 6.5%. These are monstrous numbers. And it's really surprising that the Fed is above the consensus of Wall Street. How big are they? This chart you're looking at here, here's that median forecast. You gotta go back to 1984 to see a period where the economy has been that strong. We're thinking that we're gonna see the strongest economy right now in 37 years. The world economy is at 5.6% estimated 2021 growth. That's the strongest since 2010. So the takeaway from these first couple of charts is, yeah, the economy is smoking hot and it is on fire. Why? Because COVID's going to end and we've got vaccines and we're going to all hit herd immunity through vaccines and we're all going to go back to normal. Except one little thing might be popping up along the way. Here's the daily reported infections from Johns Hopkins University. Uh-oh, they're starting to go back up again. This is worldwide right now. So we're starting to see a little bit of an increase of COVID infections. Europe, Europe, here's 1, 2, 3, and a lot of people are worried that they are again starting in wave 4. So for all the hope that we're going to get this thing done, it ain't quite going away just yet. The US is bottoming a little bit. There's a little bit of a hookup in the last couple of weeks. Usually these types of things, when it comes to viruses, tend to trend. When it turns up, it doesn't, it doesn't act like a market, but it tends to be a little bit smoother in its ways going up and down. So it's got people worried that we might be on our way back up as well too. What about vaccines? So Bloomberg does a very good job of highlighting vaccines. 574 million vaccines have been dosed worldwide. The US is 147 million of that. 16% of the US has now been fully vaccinated. And a couple of countries that are worthy of looking at is Israel. 52% of their population has been fully vaccinated right now. Chile's at 18%. The UK is a little different. They've been pushing everybody on the first shots. So they're over a quarter of the people on the first shots. Second shots are to come, but they've got a very high percentage of people on the first one. So, okay, so the vaccine is coming, even though the case counts are starting up. Will that, how is that impacting everything? Well, let's take a look at Israel. Here's their vaccine count. Here's their daily dose, and the red line is a 7-day average. They're actually falling because they're running out of people to vaccinate. And guess what? Their case count is plummeting, and it's getting very close to zero. So when you get to 52% of the people vaccinated on a second dose, it goes down. The UK is at 26% at first dose. That has an impact. There is not an increase like there is in the rest of Europe as well too. But the problem is we're still months away from that. And Europe has been a complete disaster in the way that they've been doing the vaccine. They could be many months away from that, and they're going back into lockdown again. Today, France announced more lockdowns for the next 3 weeks. And so all this hope that we're going to have strong economy makes perfect sense, provided that this vaccine doesn't get in the way, provided that we don't have another wave and we get these vaccines out. So we're going pretty good with the vaccines, but we got to go faster. Otherwise, it might start to filter into growth. Last one I'll mention is Chile. Chile's got 26% of the first doses, 17% of the second doses. They're way higher than the US, but look at their case count. Why? Because Chile opened up. Chile said, okay, good enough. We got a vaccine. Everybody take your mask off. Let's go back to normal. And they're not quite there yet, and case counts are continuing to climb. So the economy is going to be great. What's the big problem? COVID's not behind us. We need to get the vaccines going faster. If we could get to over half of the population vaccinated like they have in Israel, then we could discuss it being done. That might not be until the second half of the year, or maybe the fourth quarter at the rate we're going. And that still gives us enough time to really disappoint markets with the economy. Second topic I'd like to discuss is inflation. I think this really plays into the DeFi crowd. So here's the Fed's favorite measure, core personal consumption expenditures. And inflation looks like on a year-over-year basis, it's not a problem. But we know that last March and April, prices plummeted when the lockdowns came. And we know that they're going to roll off in the next few months. And that's what economists have referred to as the base effect. So if you look at a 10-month annualized inflation rate, this takes out March and April of last year. And eventually, when you add in, I'll add 11 months in a full year, we're at 2.34%. That is a 13-year high and one of the highest levels we've seen in the last quarter century. So what we're expecting is that the inflation rate over the next couple of months, is going to really shoot up a lot. And it's going to shoot up well over 2%. Again, everybody knows this. It's called the base effect, and everybody's somewhat dismissing it. But I'd be worried about dismissing it. The regional Federal Reserves do surveys of the businesses in their districts. So here's Dallas, the Empire, which is New York, ISM, which is the Institute of Supply Management, that's a national survey, same methodology, Kansas City Fed and the Philly Fed. They ask prices paid. And they ask you, it's a diffusion index, they ask you, are you paying higher prices, same prices, or lower prices than the previous month in 3 months? And I measure this as a Z-score over the entire period. How many standard deviations are they away from the average? Currently, we're at the highest level we were at since July of 2008. And if you go all the way back 41 years, this is one of the highest levels of prices paid, a measure of inflation we've seen. By the way, July 2008, price of crude oil was $147. That's what drove that. We don't have crude oil at barely less than half that price. So that's everything else. So there's definitely a sign that inflation is coming. Where's it coming from? It's coming from the Fed. The Fed's balance sheet as a percent of GDP has been skyrocketing. It's over a third the size of the economy. Back before the crisis began in 2008, the financial crisis, it was at 6% the size of the economy. So it is over 5x larger, and it is essentially doubled in the last year from the pandemic. So the Fed has been printing tremendous amount of money. The federal deficit is one of the largest we've ever seen. It's $3.5 trillion, or 16% of GDP. Although this chart only goes back to 1968, the last time the federal deficit as a percent of GDP was this big was 1944, was when we were financing World War II. And this is other than that, this is the second highest period in American history. So if you look at this chart here, yes, this chart goes back to 1787. The Office of Management and Budget did put together these statistics, looking at how big the economy, how much the federal government spending is as a percentage of the economy. In 2020, it was 33% of the economy. Again, only financing World War II was the largest it's ever been in the 200 and nearly 50-year history of this country. So we are spending money like crazy. We are borrowing it, we are printing it to a level that we've never seen. And how's that showing up? This, I think, might be the most interesting chart of all when it comes to it. This is personal income made up by government transfers and assistance payments. So let me explain this. Personal income runs at around $21 trillion a year. The biggest part of personal income is your salary, your wages, and then your investment income and anything else you might get in terms of income. What percentage of that is made up by, as I'd like to say, is the government just mailing it to you? Whether it was Social Security or disability or food stamps or some other kind of assistance. And now in the post-pandemic era, you can add in the $1,200 for CARES Act, the $600 checks that went out in December, the $1,400 checks that went out in the last few weeks. It was 31% of all the income of the United States was mailed to everybody through the CARES Act $1,200 checks. It got to 27% with the $600 checks. This chart will probably need to be rescaled in the next couple of months when the $1,400 checks are added into this as well too. Over a fifth of Americans' income is mailed to them by the government right now. Unprecedented in any time in American history. This chart goes back to 1960 as well too. And what's that leading to? that's leading to a monster savings rate. We all know the Robinhood effect. Everybody's putting their money in the Robinhood and they're buying stocks, and that's pushing up stocks. There's a tremendous amount of savings that people have that once they feel comfortable, they're going to start spending it. And that's inflation. And that's going to be a big problem for them as well too. And as I've liked to say, if there's no consequence to this, and I want to be clear, I'm fine with helping anybody in any way I can. But the question is this a consequence-free way to help people? And that's really the issue that I have with it. Sure, if you want to print and borrow money and mail people that are in need money, there's got to be a price. And that price, I fear, is going to be the loss of purchasing power via inflation. But wait, we've done that. We're not going to continue to do it. Yesterday, this is a story from yesterday. 21 Senate Democrats urged Biden to put reoccurring stimulus checks and unemployment aid extension in the infrastructure plan. They're referring to this as human infrastructure. This is UBI, that they want to start talking about permanently mailing people money every month. Hey, if the modern monetary theories are correct and we could do this without the consequence of inflation, that's fine. But I have a feeling that we're not going to see the consequences. That we're not going to see that. We're going to see the consequences show up in inflation. And again, we've mailed out 3 sets of checks. We're talking about mailing out more. And if there's no consequence to it, meaning something bad didn't happen, because right now the poor are getting help, the unemployed are getting a bridge, and the rich, defined as anybody who owns equities, is getting new highs, mail me more money. Because all mailing money does is it makes things better. As well, is the way it looks. Only when we've gone too far and we've created inflation will we stop, but at that point it's too late. And it's going to be really hard to put the genie back into the bottle. Final topic I want to talk about is my perspective on DeFi. And I'll start with this chart here. This chart indexes to July of 1998. That was, for those of you old enough like me to remember, was about a month or so before long-term capital crisis, long-term capital management, LTCM, had its crisis and blew up. It was kind of like the Archegos problem that we're having this week, but at a much, much bigger scale as well too. Since that period of time, in the last 23 years, the bank stocks have been terrible investments. The European and the Japanese banks have lost you 63 and 73% over the last 23 years as the stock market is up a lot. American banks have returned you 30%. But to give you an idea of how that works out, the black line is 3-month T-bills, which spent most of that period at 0 interest rates. If you had just rolled your money in cash, getting 0 interest rates, you'd still be up 55%, and the banks are up 30%. So what I'm trying to show you here is the worst long-term investment you could have picked in the last 25 years of the major stocks in the S&P 500 have been the financials. They have been a disaster. If you look at the larger financial index, since the financial crisis of 2007, they have barely returned you a positive return, up 12%. Everything else is up 225%. So what's this telling me? The market knows that the business model of the current CeFi system is broken. It has been broken for a long time. It may not know what's going to replace it, but it knows this doesn't work. And that's why people that invest in financials, I've joked around, is financial stocks have been created to make money managers former money managers, because that's all it's largely done to them over the last several years as well too. So in its place comes DeFi, and in its place comes cryptos. So the blue line on this chart shows you the market value of all the banks in the United States. And I updated this chart about 3 hours ago. And the orange line is the total crypto market cap universe. It's about to cross. That the crypto universe is about to be larger than the value of all United States banks. It was very close 3 hours ago. And I noticed that we're up a little bit more since then, that it might have actually crossed for the first time ever. This is a market signal. And by the way, if you want to know, this is how it breaks down. That's Bitcoin, and that's everything else right there as well too. This is a market signal that this DeFi universe, this crypto universe, is the new financial system. And it is coming, and it is going to replace it. These guys, these banks here, these are taxis. These are taxis. This is rideshare, is the way that I've been explaining it to my C5 friends. And that you can't do away with this. Oh, the biggest problem that they have is, oh, it will be banned. Oh, the government won't allow it. Look, you said the same thing about rideshare. The mayor won't allow it. It gets too much money from the taxi business. They're all corrupt. They're going to continue to force you to take this crappy old yellow taxi, and they're not going to allow you to take an Uber car. But it became unstoppable as well, too. And that's what gets me to my worry. And that's the last part of what I wanted to talk about. It is unstoppable. It is going to happen. It is the revaluation or recreation of a new financial system altogether. And if we don't play in it, it's going to be created by others. How is it going to be created by others? They have the means and the ability to do it. So let's take mobile phone subscriptions put together by the International Telecom Union. This is the number of mobile phones per 100 people. If you're over 100, that means you have more than one mobile phone per person. The United States is 134, 1.34 phones per person in the United States. A lot of us have two phones, a personal phone and a work phone, and burner phones, and that's how you get over 100. In Asia, it's 129. In the Middle East, it's 116. In Latin America, it's 100. And in Sub-Saharan Africa, which is probably one of the poorest places in the world, 87% of people have mobile phones. Everybody has a mobile phone everywhere as well. And those mobile phones work. If you've ever been outside the United States and tried to use a mobile phone, the first thing you realize, and I won't mince my words, is how shitty the service is in the United States. The third world service of mobile phones is located in New York City. It's located in Laguna Beach, where I'm at right now. According to All Connect, the US ranks 38th in mobile download speeds and 95th in mobile upload speeds. Albania has better speeds than the United States. So the rest of the world has the tool, here's my phone, has the tool in their hand in order to use DeFi. Well, what about sending money, money? Well, GSMA, the Global Standard for Mobile Association, puts out a statistic every quarter, the number of mobile money accounts registered. I looked at just Latin America, the Middle East, Asia, South Africa, South Asia, and Africa. There are 1.2 million accounts that are registered. Well, excuse me, let me rephrase that. 1.2 billion mobile money accounts. Now, these are traditional CFI accounts where you can send money back and forth as well. Of those 1.2 million, 430 million of them were used in the fourth quarter of 2020 alone. So let's stop with this idea that the third world, I'm talking about what my CFI friends tell me, they've watched too many movies with Leo DiCaprio in it, Blood Diamonds is what I'm thinking about. They think the third world is just a bunch of people basically bribing border guards with diamonds to get themselves out of these terrible countries. No, they're all walking around with LTE connections on iPhones, and they're texting money back and forth to each other to a greater degree than we do in the United States. They do that now. So if you're going to introduce to them a new digitally permissionless, decentralized financial system, they're ready to go. They're ready to go right now. Just show them what app they have to download and go with, and they're on their way. If you look at a number of studies that have been done of who buys cryptos, it is third world countries that have the highest level. Nigeria, in 2020, a survey was done. Nigeria said that 32% of its population had either owned a crypto or currently owns a crypto. In the United States, it's 5%. So they're all ready to go with this as well too. So when I hear and I see, our regulators talk about, AML rules, which is anti-money laundering, KYC, which is know your customer rules, that we have to be careful with this, that they summarily announced that Bitcoin can't be a medium of exchange, and they're setting up to basically tell everybody you can't use it. They're telling everybody to sit this one out. If we sit this out, the rest of the world is going to create that standard, and they're going to force it on us. Oh, but what about these regulatory rules? Well, GSMA has this neat little chart that they put together of a regulatory index, and it shows, where regulations are very high in the United States and in Europe, also in China, interestingly as well too. And they show where regulations are very low in South America, in Africa, in the rest of the Middle East as well too, and in Asia, where those 1.2 billion accounts are, that 430 million of them mobile money accounts were used on mobile phones. These people are fine with the idea that they don't have stringent AML KYC rules. Show them how it works and they'll be off to the races. So my biggest concern when it comes to this whole DeFi space is our regulators are going to make a giant mistake and they're going to force us to sit this out. And if they do, the world is going to set the standard. Oh, but they don't have the money. No, but in the Middle East, they'll tell us that this new standard, we got to pay for it with crude oil. They're going to tell us that we're going to have to buy raw materials with this new standard as well too. Finished products out of Asia that that Walmart buys, that puts on their shelves. They're going to have to pay for it with this standard. And if we have no say in developing that standard, we are going to lose. The biggest reason you hear Americans push and Europeans push, because they're the winners in the current unfair CeFi system. They don't want it to change. But it's not a question of whether or not they can prevent it from changing. It's going to change. The question is whether or not they want to play along with it. And my fear is that the regulators are setting up, and I'm talking about Janet Yellen, Jay Powell, the Biden administration, with the exception of Gary Gensler, who I think gets it, but he's one voice, and I hope he's the voice that will win the day, but I'm not so sure he will. That they think that they could shut this down and keep their current system, which is unfair but benefits them, going, and everybody will accept it. Kind of like mayors thought, oh, we'll just shut down this rideshare thing. And don't worry, you yellow taxi guys and you checker taxi guys, you'll be fine. We'll take care of you. But in the end of the day, they couldn't. It became unstoppable. So that's my biggest fear about with DeFi. Let me stop there. And let me say that I did send my slides to Emran. So if you didn't get a copy of them, he could maybe forward them on to you. And I'll open it up for any questions that anybody has. I'm looking at some of the questions in the chat right now. I guess, is that the way I'll take the questions, is just take them out of the chat? Let me see if there's.
Yes.
Yeah.
Anyone, if anyone has actual questions, I can unmute you and you can ask questions directly, or we can have Jim continue with the presentation.
Yeah, I mean, I'll just read some of the questions out loud, I'll just read some of the questions out loud and try and answer them as best I can. Opinions about whether the question isn't if inflation or whether it is about current metrics capturing inflation. Now that's a good question. There is an issue that I'll mention to you about inflation. Typically, the way the government measures inflation is they send physical price checkers out to brick and mortar establishments to actually look on the shelf, to actually look at what the prices are. That's the way they do it, but not in the pandemic, because you can't, because brick and mortar places are closed and the price checkers aren't able to do it. So they've literally said they're either looking online, or they're calling up the stores, or they're estimating, which means wild ass guess. Now, maybe that's not a bad way to do it, but it's a serious break from the way that they have done it. So we don't know what inflation would have been a year or 2 or 3 years ago on this new system that they're doing right now. So it is a different way that they're doing it. And so, yeah, the metrics, I don't know if they're missing inflation, but they're different. They're definitely not the same that they were before, as far as where we're going from here. And that needs to be understood as we look to inflation. Look no further than interest rates. Interest rates have been relentlessly rising since August. And one of the big debates that we're having on Wall Street is why are they rising so much? And the answer is because I think the market is getting more and more worried about inflation. And the reason it's getting more and more worried about inflation is because we just keep sending everybody money and we keep stuffing them full of money. And whether or not we get to herd immunity through vaccines sooner rather than later, we will eventually, and everybody's gonna have money to spend, and we're gonna have a lot of inflation then at that point. And that's been what the fear has been as well.
Jim, you had a
question. Yeah, go ahead.
I'll pass it over to Akin. Akin?
Yeah, hi, Jim. So going back a few slides to where you're talking about inflation. So it sounds like, if inflationary policy continues, that continues to sort of provide fuel for, crypto and DeFi. But what happens in a scenario where rates start getting tightened because, inflation just starts to show up, right? You talked about the consumer starting to spend once confidence comes back and, COVID gets addressed. Does that just wreck the stock market? And, because now valuations will have to, take into consideration a different discount rate. And if that scenario does happen, like, how do you see that impacting crypto and DeFi?
Yeah, so I think you're right. This is the concern, is that rising rates, if it is interest rates going up, let me start this way. Interest rates going up is neither good or bad for traditional financial assets. It's why. If interest rates are being dragged up higher because you've got booming growth, everybody's getting a job, people are getting more money, they're feeling more confident. Okay, the financial assets can tolerate higher inflation. Higher interest rates. If they're being driven somewhat by inflation, and let's remember, we haven't seen that in 25 years. That's not so good. That's a loss of purchasing power. That is a lower standard of living. And that would be greeted poorly by financial assets. You're starting to see the beginnings of that as interest rates have gone through 1.5% on the 10-year note. The tech stocks, which are considered long duration assets, the ARK type of companies, the NASDAQ 100 type companies, have been wobbling a little bit lately because of higher interest rates. And that's because it greatly impacts them. So if rates go up because of inflation, which is what I'm fearing, although the Fed will tell you, no, it's going up because everybody's broken out into, of course, God bless America, and it's all a great place, and that's why rates are going higher. But if it is about inflation, it won't be treated well in the financial markets. It will make the stock market more volatile. It'll make it go down. It'll make it more difficult to be an investor in that area. And it will benefit the crypto universe, because the crypto universe will be sitting there saying, see, there is problems here in this permissioned world, that the permissioners, if I could use my bad language, have made errors. They've made errors in judgment, and we all have to pay the price of it. And we've got this new permissionless world that's coming that doesn't have those problems. So I think it would be a benefit to it. And that's why I think what you've seen with the big rally that you've seen with cryptos in the last several months has come on the back of higher rates, has come on the back of this fear of inflation as well too, because it is a concern that we're going too far and there is going to be a price to pay. And there is an alternative that would have said you would have never paid the price here had we been in charge. Hope that answers your question. If you have a follow-up or any other questions as well too. Let me throw out a question. What will it take for regulators to fully accept DeFi?
Jim? Might have lost you. We'll wait for him to hop back on. He's joining in a minute. We'll give it another minute or two. He said he's going to join back up. Sorry for the delay there. Must be, there he is. Let me unmute you.
I'm back. Can you hear me? I'm back. Can you hear me? Can you hear me and see me? Okay, good. I apologize for that. That was the Bill Gates blue screen of death that jumped on me right there. I guess I shouldn't be using that product, but I should be using the MacBooks, but I don't. I use a Surface. But I'm back anyway. Let me answer the question I was about to answer right before I crapped out on you. What will it take for the regulators to accept DeFi? An understanding that they can't stop it. They think they can control it. They think that they can control it, including killing it. They think they will decide when, how, where, why, and by what method DeFi will be created. Look at the Federal Reserve. The Federal Reserve last year announced that they're going to create a version of FedCoin. And how are they going to do it? They're going to have it ready to go in 5 years, in 2025. They're going to, and they said that they want to make sure that it's stable, it works, it doesn't give anybody any problems. So this is how they're going to do it. They're going to take 2015 technology. They started it in 2020, and they're going to introduce it to the world in 2025. It's not going to work. Oh, they'll have a Fed coin, but it won't really work. It won't really amount to anything. And neither will any CBDC ever amount to anything, because they're all going to try and do the same thing. They're just going to try and create the CeFi world with a little bit of a digital coin, but not really change anything. So I think in order for them to accept it, they have to understand it is happening with or without you. And you might as well get on board. Gensler, Gary Gensler, the head of the SEC, the former head of the CFTC, completely gets it. He's one voice of many. You know who doesn't get it? And she has said she does not understand this stuff at all, 1 inch, is Janet Yellen. Does not understand this stuff in the slightest. Joe Biden does not understand this stuff in the slightest. Kamala Harris does not understand this stuff in the slightest. Hopefully they turn to Gary Gensler and say, explain it to us. And he tells them, this is the world that's coming. We got to get on board. Instead of them thinking, this is the world that we have to squash and get rid of and push off to the side and marginalize. Because if that's what they think they can do, they're never going to let us get on board. So that's what it's going to take to get regulators on board, I think. It's just an understanding that this is happening and that this is not going to, they cannot stop it any more than the mayor of New York can stop Uber. Once he realized he couldn't stop Uber, and once he realized he couldn't regulate it out of business, then they just started to accept it then at that point. Any other questions or any other follow-ups to that as well? I lost all the chat before I rebooted, so.
Yeah, there's many questions, but I know we had originally scheduled for 30 minutes. I don't know what your time is, maybe another.
I got a few minutes to answer questions. Is there anybody behind me that we're holding up?
No, you're the final.
I can answer. I can answer questions. I can run into the overtime answering questions if you want. So go ahead.
Perfect. So if everyone can, repaste their questions again, that'd be great.
Yeah.
But the first one is, how do you think DeFi and stablecoins can impact emerging market currencies as they are weaker compared to dollars, especially when we can get yields in dollars and simply convert it when we need it?
I think though, repeat that question one more time because you broke up a little bit on me on that.
No worries. It's in the text box if you can see it as well. It starts with Jim and Andre from Brazil here.
Oh, yeah. Okay. How do you think DeFi and stablecoins can impact emerging market currencies as they are weaker compared to dollars, especially when you can get yield in dollars and simply convert it when needed? I think the biggest thing that you could see what will happen with a lot of the stable currencies is a lot of the rules that you have associated with getting dollars and converting those dollars as you want to your local currency will go away. Look at an extreme case like Venezuela as well too. There's been instances in Venezuela where they've threatened to jail you if you walk around with dollars in your pocket. That will be done away with in a stable coin kind of world, especially when you've got an encrypted account on your phone. Police can take your phone and look at it all they want, and they're not going to find anything on it unless you give them your password as well. I do think though that once you get into this whole new world, especially when you get into staking and liquidity pools, it's going to change the equation on getting interest rates and getting yourself it's going to change everything in that regard. But what it's also going to need to happen when you get into that world is hopefully you start introducing, let me call it the real economy. That you get real companies to say, I'm going to use this DeFi world as a source of financing and a source of payment. We've got, the beginnings of that literally this week with Visa now accepting stable coins on the Ethereum platform to get paid. The adoption is definitely coming. But once you get that more of an adoption, then I think you're starting to move more towards a currency that's a lot more stable, a currency without a lot less permission that you need right now. And I think it would be a big benefit to the emerging market. Look, you guys out there in the emerging markets, you already have your phones, you have your fast connections, you have your mobile money accounts. You know how to do this. Just need to be told what app to download and start doing it. And away that you go as well too. Let me take a couple more of these questions. What happens in the incumbent sectors when the USDC as a percentage of foreign reserves substantially decreases? That depends. That depends on what David Solomon of Goldman Sachs and Jamie Dimon of JP Morgan decide to do. Now, Jamie Dimon famously said that he would fire anybody who traded cryptos in 2017 at JP Morgan, and now they're creating JP Morgan coin. So his thinking has come a long way in the last 4 years as well too. And Solomon and Dimon, their biggest concern right now, what are they talking about right now? They're talking about getting everybody back to the office for 60 hours a week, because that's what they believe needs to be done, that everybody who works for their bank has to be chained to their desk 10, 12 hours a day in the office in a big building in Midtown Manhattan. So they're not thinking, I don't think, properly about this. So you're asking what incumbent sectors of USD happens when reserves substantially decrease. It depends on whether or not they want to continue to fight for the CeFi world and continue to hold on to that, or if they want to let go and start joining the DeFi world. Now, they let go and start joining the DeFi world, they're going to lose because they've got all the power right now. So I suspect that they're not going to do that. They're going to fight. They're going to fight because that's the current setup benefits them. And they like it the way it is. It benefits them. They want everybody at their desk 12 hours a day working on the current settlements. That's what they want. They don't want to think about this other world. But you know what? Outside the United States, in Latin America, in Africa, in Asia, in the Middle East, they're all ready for it. They're all ready for it. And that's where I think it can come as well too. So they're going to fight it initially, and they're going to lose initially before the thinking gets changed around with a lot of this. Many proponents of money printing claim it isn't money printing because it doesn't increase the currency in circulation. These same proponents have never talked about asset inflation. Have you seen a good measure of asset inflation? How does QE fiscal policy actually lead to asset inflation? Any specific mechanistic examples? Yes. The Federal Reserve will tell you that money printing, which is the vernacular for QE, which is expanding the balance sheet. And let me be clear here on what they do. Every day, the Fed calls up a bunch of banks that are the primary dealers. And they say to the bank, sell me some US Treasuries. And they sell JP Morgan, to use another example, same example, sells the Fed $100 million worth of US Treasuries. Well, how does the Fed pay for it? JP Morgan has a reserve account with them. And the Fed could just go in there and say, we'll just change the number in your reserve account and add 100 million to it. That's how they pay for it. That's what the money printing is. That's what QE is. We will buy up all of these treasuries and we'll just change the number in your reserve account. A friend of mine once called it legal counterfeiting. That's what central bankers do, is legal counterfeiting. And that's a pretty good description of what it is. That suppresses interest rates, that holds them down, that forces people in the rest of the investment world go, well, I don't want to own these low yielding instruments. I'll look out to take more risk. I'll buy some corporate bonds or I'll buy some high yield bonds. And then those rates go down and then those people look to take more risk and they'll buy equities. And then those go up and then they'll start to buy, over the counter equities. And so that moving out the risk curve continues. So that's how QE works. So the Fed will be somewhat disingenuous. We don't buy equities. Of course you don't buy equities. You suppress interest rates and you force everybody else looking for a return to take more risk. And that's how equities get impacted by it. You don't get your hands dirty on that. You start with the base level of treasury and interest rates and you keep them suppressed. And if you're Europe, you've got them negative. You've actually pushed them negative as well too, to try and force people out the risk curve as well. So that's the best example I can give you for it is two. Governments live on tax revenue. How do you imagine governments can collect tax in a DeFi transactions world? There's a thing called a use tax. If you're very, very wealthy, you're familiar with the term use tax. If you buy an expensive painting or if you buy a $69 million Beeple, you might get bagged with a use tax. The act of owning it, they will impose a tax on you. They can use tax you. They can use tax you because you own a car. So you're going to pay a tax on that. They can use tax you because you own a house. They'll use tax that as well too. So they could move from income tax and other forms of financial revenue to the fact that you own something and put a use tax, the fact that you use it. You own that picture and it's on your wall. You have to pay for it to be on your wall. It's legal. It's not very well used because it's hard to use a use tax. That's why it's only used in extreme examples. If you buy a $50 million impressionist art painting and you live in New York or California, they can bag you on a use tax on that, but they're not ready to go all the way down and say, well, there's 88 million cars in the country. Why don't we use tax the 88 million cars? But once they've lost their revenue source from traditional financial revenue, they could go that route as well too. How specifically are you advising your clients to participate in DeFi at the moment? Or are you yourself using DeFi on behalf of your clients? I am using DeFi personally. I am yield farming. I am staking. I bought an NFT. I'm trying to learn the process for myself, and I've been doing that. I've been involved in crypto since 2017. I've been involved in DeFi since DeFi summer as well too. What I'm telling my clients are traditional CeFi clients. They're older. They understand the CeFi world. I am literally trying to tell them that you need to open up your mind and start to understand this stuff. I'm at that stage. Accept it. Accept that this is there and that this is real. I don't feel qualified to be the guy that mechanicalistically is going to show them, how to open a MetaMask wallet and how to do this stuff that way. There's others that can do that. But in my role, I've been trying to just say to them, quit trying to dismiss this. or in a lot of cases, they've never heard of it until like a month or so ago as well, you know, and understand that this is a big deal, and don't find ways to try and say that it's not going to last or something along those lines. So that's where I'm at with my client base. But most of my client base, I do talk to them a lot about traditional CFI stuff, you know, whether the stock market's going to go up or down, or what interest rates are going to do, what the Fed is going to do, what impacts those types of things. Is inflation going to come back, growth in the economy? That's what I spend most of my time talking to them about. And along the way, I'm trying to explain to them, if you want to look over the hill longer term, this disruption is coming. And it's one of my slides showed. I said, why do you think the bank stocks have been such terrible investments for the last 25 years? They didn't know DeFi was coming. They just knew that model didn't work. That's what the market was saying. This model doesn't work. We don't know what the model is going to replace it. Now I'm starting to see the model that can finally start replacing it. If DeFi returns is one of the key drivers for mass attraction and adoption, do you think the returns are sustainable in the long run? They are, if you get mass adoption. If you get the traditional world, in order to, you know, if you get companies to start looking at that as a source of financing, a source of payment, a source of investment, and that it isn't run as a parallel to the real economy. It is being run as a parallel to the real economy now, because I see it as being a way to stress test it. So the AMMs and the liquidity pools, they need to be, you need to show that they work. You need to show that they work and that they can handle volume and that they're ready for prime time. So that's where their use is and their importance is now. But eventually, if you really want to get these things to really blow up in huge size, you need to go to the Fortune 500 companies and say, okay, now we've got a way that you could finance yourself, and you can accept payments, and you can make payments, and you can consider your treasury to use these tools as a form of investment as well too. That will come over time, and I know more and more, literally every day, people are starting to look at this stuff and starting to starting to think about that in the longer term. A lot more than 90 days ago, a lot more than 6 months ago, a lot more than a year ago, and in 30 days, 90 days, and in 6 months, they're going to be even thinking about this a lot more. In terms of long-term global outlooks, what are your thoughts regarding Ethereum as opposed to Bitcoin as sound money, given the upcoming changes in Ethereum's economic structure? So I know EIP 1559 is coming, and layer 2 scaling is coming, and ETH 2.0 is coming, and I know all that stuff is coming, and it's going to help to lower the gas fees, which I think is going to be critical, because I think one of the biggest problems I have with the CeFi world is, okay, I'm all in on this, Jim. I'm going to go open up a MetaMask wallet. I'm going to start doing this, and then I get a call the next day later and go, holy shit, look at these gas fees. This is not going to work in the long run. Like, be patient. They're going to fix this stuff as well too. But to your point about Bitcoin, if I can make a statement, people I detest the most are the Bitcoin maximalists that think that everything else has to go to zero and all you need is Bitcoin. Look, the day that everything goes to zero except for Bitcoin is the day Bitcoin goes from 60,000 to $5. Bitcoin needs DeFi, and DeFi needs Bitcoin. Just like the current CeFi system needs gold, and gold needs the current CeFi system. It is a store of value. It has an important role. But to argue it is the only thing you have, they're just like the gold bugs that think that all you need in your life, they're Peter Schiff, all you need is gold and nothing else. All you need is Bitcoin and nothing else. That is a mistake. They need both of them together. Bitcoin will be the store of value. Its price can go to the market cap of gold, which would put it, you know, well above $500,000, maybe even closer to $1 million. But Ethereum and the DeFi world, that's going to be the engine of the financial system. That's going to be the payment system. It's going to be the investment system. That's going to be the insurance system. It's going to be the lending system, the borrowing system. And that can really collectively go. Now, one of the things people have asked me about with that is, well, how do I invest in it? I said, well, that's the problem. There's all these protocols. There's the Binance Smart Chain. There's Polkadot. There's Cardano. There's the Ethereum network. There's more coming. I don't know who's going to win. So a lot of people say invest in everything. And even if 95% of it goes to zero, the few that are going to win
Hey, Jim. I think you're on mute or can't hear you. Your AirPods, maybe? I'm not sure. It's on mute. So I'm gonna go ahead and unmute. There you go. Not yet, still. Not yet. Here, let's try this. I try unmuting. There you go.
How about now? Can you hear me now? Hello?
Yes, we can hear you.
No, I can't hear you.
Can you hear us now? Can you hear us now?
Hello? Can you hear me now?
I can.
Okay, is the quality okay now?
Quality's fine.
Okay, good. I don't know what happened. I didn't touch anything, but I did give me a little error. All right. So I forgot where I was, but at least I didn't blow up this time. See, this is what happens. I'm in a resort, and this is what happens when I use the resort. When I use the resort's connection as well too.
No worries.
So I was talking about Bitcoin and Ethereum, and I'll just conclude with that idea. I will just conclude with that thought that they both need each other. Just like gold needs CeFi and CeFi needs gold. You can't have one without the other, and that they work better in concert. And somebody else asked the question, Bitcoiners are convinced that all DeFi will eventually be built on Bitcoin as opposed to Ethereum. Well, okay, show me the smart contracts that are built on Bitcoin. I'm ready to see them. I've been waiting here. It's only been 11 years, and I'm not sure how that is going to work. But like I said, there's going to be a lot more standards and a lot more protocols coming in the future. And only one or two or three of them are going to win out and be the standards. Like I was saying, I remember what I was saying before. We had 100 automobile companies in 1900. We knew that the automobile was going to replace the horse and buggy, even though the buggy whip manufacturers were saying that these automobiles are terrible, they break, they're uneconomical. But we knew that they were coming. But by 1920, we were down to 4 automobile companies and then eventually the big 3. And that's where we are right now with DeFi. There's going to be dozens and dozens and dozens of standards, but only a few of them are going to win out. Maybe it is the ones that we have now, or maybe it's a standard that hasn't been created yet. But the point that I've been trying to tell people is one of those standards will win and will be it will be the backbone of the new financial system. And it won't be a name of J.P. Morgan regulated by the Federal Reserve. That I don't think you're going to see. That's what I think you're going to continue to see as far as where we go from here. Another question is, what are the biggest problems DeFi needs to solve to cater to the large institutions and companies? That's an easy one. I think it's the front end. Look, I consider myself to be computer savvy, probably not as computer savvy as a bunch of you guys are, but it's hard. It's hard to open an account, basically start off in Coinbase and buy some ETH in Coinbase, and then open a MetaMask account, transfer it to MetaMask, connect to a DeFi protocol and do some yield farming or do some staking or put your money in a liquidity pool. I always, every time I do it, I keep thinking to myself, how do I explain this to my mother? How do I tell my mom, stop getting zero in the bank and go put your money in a liquidity pool on Uniswap? But you got to open up an account at MetaMask, but go through Coinbase to get your ETH into there. There's no chance whatsoever that can happen. 90+% of the country, I think, is going to look at this stuff, attempt it, and just give up because it's too much. I understand that the standards are changing so fast that nobody wants to sit down and write a neat front end. Maybe Dharma's got a good one. I was looking at that the other day. It seems promising, and this stuff keeps coming every single day as well too. But you've got to make it so that some of my customers who are executives at CFI companies, they think high technology is a group text. How am I going to get them to open up a MetaMask account and connect to Uniswap and then stake some of their coins? I don't know if I can, but you got to make it so that it's easy enough for them to do. So that's what I think this business needs. That's what I think this business needs in order to bring in the rest of the world. But I understand no one wants to sit there and write that front end, because by the time you're done with it, the standards have changed 3 more times and you're always playing catch up and you're never on top of things. Back to inflation. In the long, medium term, would producers be able to pass prices on to consumers? I think the best way to answer that question is, do they want to? For the last quarter century, if you've been a manager of a traditional company, you've been taught that because of Google, because of Amazon, if you sell a dishwasher for $599.99, and somebody else prices their dishwasher at $599.95, 5 cents less, 4 cents less. On a Google search, when they sort by lowest price to highest price, you're on the second page because everybody's at $599.95 and you're at $99. You're not going to get any sales. So you've been taught to never, ever, ever raise your prices, because if you raise your prices, you're going to lose tons of market share. So you find other ways to do it. But if we break that psychology and that I have to raise prices because my raw material prices are going up, the demand for stuff is going up. Look at the way we deal with it now. And not, if you've ever gone to a furniture store, I happen to be into bicycling. I own a couple of road bikes. If you go and try to buy a road bike right now, you go in to the bike dealership and there's the price, and it's the lowest price on the list, and you sign up, fine. You'll get your bike in some cases in a year. In a year is when you'll get your bike. Why? Because they're rationing them instead of raising the prices. And that's because they've been taught to never ever raise prices, because if you do, you lose market share. If you raise the price of that road bike by $100, I'll go buy a different one that's $100 less. So to answer your question, in the medium long term, will the producers be able to pass along high prices to consumers? Yes, but will the producers want to? Because they're so afraid. But once the psychology is broken, and the Fed calls that unanchoring, then I think then we're all in a whole new ballgame then. And we're in a ballgame where everybody's managing against prices, and raising prices is acceptable. Right now, it is not acceptable at all to raise prices. And that's what the Fed is banking on. But that's the risk that they're facing, is that they're going to put everybody in an intolerable position, and that they're going to have to finally raise prices as well. Procter & Gamble just raised prices on diapers and a lot of other things just the other day as well. So, and that was considered verboten even a year or two ago. You never raise the prices on that stuff. And so we'll have to see how that goes. But really, I think the question is, will they? Because if I'm an executive at one of these companies, I became an executive by understanding that I never ever raise my price, because I have to be on the first page of a Google search, lowest to highest price, or I'm never going to sell anything. And that's why that mentality, I think, is still holding in place. I'll find ways through technology and other ways to cut my costs in order to keep that price. But if we start getting people raising prices, we're going to be in a whole new ballgame as well too.
Awesome. I know we took up some of your time during your vacation, so I don't want to take up any more of your time, but we really appreciate your time and some of the thoughtful answers you gave over the past hour. Any final words, Jim, that you'd like to kind of give to the audience or to DeFi crowd before we end our session?
Yeah, at Bianco Research, or follow me on LinkedIn as well too. Shoot me off some questions and some comments. I talk about a lot of these subjects there online.
Awesome. I've also shared your Twitter and your website in the chat group, and your LinkedIn was shared earlier. So we're all
Okay, good. Thank you. I'll talk to you guys later. All right,
Really,
bye-bye.
Take care. Bye. And thank you all for the attendees that have joined. We'll be publishing our recordings here very shortly. Thanks so much.